Yeah. Leela, yes, I will be explaining your requirement. So just I saw it. Last 30 minutes of the session will focus on the doubt clarification. Okay, is that okay for you? Yeah. So whatever queries you have, you can let me know. So last 30 minutes we'll plan that. Okay. And I believe all the participants might have gone through the MCQs in the examination kit. So if you can remember, just I gave an assignment the last Friday. Yeah. So if you didn't understood any specific MCQ, feel free to ask me. So last 30 minutes we'll have a session. Okay. Now around 65 participants join. So we'll be waiting another 2 minutes. Then we'll go to the session.
Recording in progress.
Yeah. So last session we had a discussion on the relevant cash flows. Now we'll be starting with our basic investment appraisal techniques, or we can also consider these as traditional investment appraisal techniques. So a finance manager, in order to make the finance investment decisions, first he will be considering these basic investment appraisal techniques. So these are the accounting rate of return, and the next one is payback period. So accounting rate of return, or we can also consider that return on capital employed. So first we try to understand what exactly it is. Now, in order to select a project among the alternatives, so here we will be considering what is the ROC, nothing but return on capital employed of that particular project. So it is very, very simple to calculate, but do remember from the examination point of view, they will mainly focus, especially for section A MCQs, they will mainly focus on the strength and limitations of this particular investment appraisal techniques, because generally most of the students just they will be focusing only on the formula, but I don't think formula is an examining point. So your examiner will mainly focus on the strength and the limitations. So just have a look on this that also. So first we try to have, understand the formula. So return on capital employed. So it means that the formula is average annual profit before interest and tax. It means before considering the interest and tax, whatever the profit is there, that we consider it as average annual profit before interest and tax, and the initial capital cost. So initial the investment. So whatever the initial cash outflow is there, that we consider it as initial capital cost into 100. Now, alternatively, you may be asked to use the average capital instead of initial capital, and how this average capital will be getting initial capital plus residual value. Suppose if you are expecting any residual value, so that will also be added, divided by 2. Now do remember, if nothing is mentioned in the query, always it is preferable to consider the average capital instead of initial capital. So if they specifically mention that you should consider the initial capital, then you can go with that. If nothing is mentioned, you need to consider the average capital. So just see the formula. The return on capital employed is average annual profit before interest and tax divided by initial capital cost into 100. So initial capital is nothing but I already mentioned whatever the initial investment is there that we consider it. So for calculating the average capital, we do assume the scrap value, nothing but residual value divided by 2. So the key points which are to be considered. So errors are often made through though trying to calculate the return on capital employed using relevant cash flows. Now do remember most of the students generally they try to apply the relevant cash flows for calculating the ROC. But here we should not consider the relevant cash flows. We need to focus on the profits because it is a profit based investment appraisal technique, not a cash flow based measure. So always we should consider only the profits rather than relevant cash flows. Similarly, the project investment should include book values of the asset. This is a very important point. Uh, See, here just I am continuing the previous concept. Previous last session we had a discussion on the relevant cash flows. Now just we started with the traditional investment appraisal techniques. So that is the return on capital employed. So whatever you are seeing on the screen, so this is the first concept which I just started. Okay. So it is related to basic investment appraisal techniques, and we just started the discussion of return on capital. So I hope there is no confusion for you, Nandit. Yeah. So here the first point, just let me give a quick overview. So as I mentioned about ROC, in addition to the formula, students should mainly focus on strength and limitations of return on capital employed. Both return on capital employed and payback is considered as basic investment appraisal techniques. And in ROC, return on capital employed is mainly a profit-based investment appraisal technique. So here we should not consider the relevant cash flows. And the formula for calculating the return on capital employed is average annual profit before interest and tax divided by initial capital cost into 100%. And if nothing is mentioned, always we need to consider average capital. How we will be getting the average capital cost? Initial cost plus scrap value divided by 2. So this was the thing which I spoke. So I hope the overview is clear. Okay. Yeah. So the key points, as I mentioned, we should not confuse with. We always need to go with the profits. And the next important thing, the project investment should include book values of the assets employed. So it means whatever the assets which we are considering, we need to consider the book value rather than the market value, because we can expect an MCQ on this. Do we need to consider the book value or market value while we calculating policy? Always we need to go with the book value. So I don't think the formula is uh, difficult for you. It is very easy to understand. Anyway, we'll discuss a small illustration on also. But before going with that, let me focus on the key points. I can see that still some students are joining. Once again, I repeat, so always try to join the session 5 minutes before. Yeah. So now first we focus on the strength and the limitations. Because as I mentioned earlier, for section A MCQs, they will focus mainly on strength and limitations. So the strength of return on capital employed or accounting rate of return. So here expressed in terms familiar to the managers, because generally managers are very familiar with the return, that is net profit percentage, gross profit or the operating profit. So if you express something in their familiar terms, then it would be very comfortable for the managers to make the decisions. So in case of return on capital employed also, we are trying to express the performance or the projected performance of a project on the basis of a percentage, nothing but return on capital employed. So it will be very easy for the managers to understand and easy to calculate the likely effect of the project on the reported profit and loss account balance sheet. And managers are frequently rewarded in relation to the performance against these variables. So I hope you might have recollected this from the last concept. I already mentioned that most of the managers generation are linked with the performance of the business. Now, generally, how we generally measure the performance of a business by considering the ROC. So it means I'm speaking by considering there either the percentage of net profit or the gross profit. So it is easy calculate. It is very simple to calculate and to execute the formula. Next, businesses are judged on return on investment measures by the financial market. Now, normally, if you see most of the financial markets, even if you can recollect the last session, I spoke about certain listing requirements by the stock market. So the listing requirements will also be projected in terms of ROC. It means the financial market try to measure the performance of an entity on the basis of return on capital employed. It means what was the return on capital employed in the last year and what is the return on capital employed in the current year, so that they can observe whether there is any growth in the ROC or not. So these are the strength of this return on capital employed. So I request the participants once look into this and you can let me know if you have any query on these strengths. Any question? Shall I discuss the limitations then? Last point. Okay, let me explain. See, businesses are judged on return on investment measures by the financial market. It means, yeah, I will be explaining the second point also. Yeah. So first I will be explaining the last, then we'll go with the second point. See, businesses are judged on return on investment measures by the financial market. It means generally, if you want to assess, yeah, yes, I will be explaining first point. Now, if you want to assess the performance of a business, now let me give an example. Normally, the financial markets or the stock markets, now if they want to measure the performance of an entity, they will consider the return on capital employed as a best measure. Suppose if I want to measure the performance of the student, so what I will consider, so I may consider the marks which are scored by the student in their examinations. So the marks, it means out of 100, how much percentage a specific student got, whether 90% or 95% or 99%. On this percentages, I try to assess the performance of a student. In the same way, this financial market. So financial market means I'm mainly highlighting the stock market because generally we relate, we do consider only the stock market, right? Now, if you consider the stock market, they try to assess the performance of an entity on the basis of ROC. It means what was the company ROC in the last year and what is the current ROC. So the return on capital employed is considered as a, yeah, I will explain this. Yeah, do it. So it means that the return on capital employed is considered as a basic measure to assess the performance. So that's why we do consider it as a strength. So most of the participants of the financial markets, they do consider ROC as a measure to assess the performance of an entity. I hope the last point is clear. Now, anyway, I will be explaining now the first and the second point. So the first point says that expressed in terms familiar to managers. Now, generally, managers they want the information to be projected in percentages. Now, it means that what I am trying to say, They are not interested to know the performance in absolute terms. Suppose if I let us assume that I am a finance manager in a company and my superior asked me the performance of a company for the last 3 years. Suppose if I say that in 2019 the company profit was 10 lakhs 95,400, and in 2020 if I say the company profit is 13 lakhs 16,800, and in 2020 my company profits are 19 lakhs 75,500. Now, if I give these kind of information to my superior, definitely he won't be appreciating me, because he don't want this. What he is expecting from me, what is the profit? What was the percentage of profit increase from 2018 to 19? Now, let us assume that in 2018, the return on capital employed, if I say that 18%, and in 2019, it increased to 20%, and in 2020, it increased to 21%. So it means that this particular information is very comfortable for my superior to make the decisions. So always the manager level personnel is very much interested to project or to get the information in these percentages only. So that's why I'm saying this, our return on capital employed is a strength, because if in this case also we'll try to project in percentages. ROC, return on capital employed. If I say that 20%, so the return expected from the project is 20%. So this will be very comfortable for the manager to make the decisions. So I hope the point one is clear. And when it comes to the point two, second point, easy to calculate the likely effect of the project on the reported profit and loss balance sheet, and managers are frequently rewarded in relation to this. So generally manager remunerations, emoluments are mainly linked with the performance of the entity. It means it links with the these kind of percentages. Suppose a company might declare that if a project ROC is 20%, will be paying 3% as commission to the managers. It means their emoluments are mainly linked to the uh, return on capital employed. So if a project succeeded in maximizing the return on capital employed compared with the last year, then the manager might be getting a better emoluments from the company. And next important point in the second one is easy to calculate the likely effect of the project on the reported profit and loss. Now let me give a small example here. Before starting the project, let us assume that the return on capital employed is 15%, 1 5. And if a company decides to go with a new project, it means if they want to go with this a new project, the return on capital employed will be increased from 15 to 30%. Now here it is very easy for the managers to understand the contribution of a new project in maximizing the return on capital employed. So this is the second point. In simple term, ROC, if the project performance is measured in ROC, it is very easy for the manager to make the decisions. So did I address all the three strengths of ROC? And one more request I got to explain about the average capital employed. This is very simple. We do consider the capital employed plus the residual value. Residual value means if you are expecting any recoverable value from a project at the end of the span. Now, for your better understanding, let me give an example. A company got a project, and as per the project requisition, they need to construct a temporary building. It means that in order to execute a project, in the process of executing the project, they need to construct a temporary building. Now, and the project will be completed. The project, in the sense, the life of the project is 5 years. It means the project will be giving the returns to the company for a period of 5 years. After 5 years, we will be shutting down the profits, nothing but the project. Now, in this case, I already mentioned about a temporary construction. So after completing the project, you need to dismantle the temporary construction. And when you dismantle it, whatever the scrap is there, at least you will recover certain amount from that. So that is known as residual value or the scrap value. It means after using or after completing the useful life of an asset. After completing the useful life of an asset, the amount of nothing but the recoverable amount which you are expecting from that, that is known as residual value or the scrap value. So for calculating the average capital employed, initial capital employed, suppose for starting the project, I invested $1 lakh, and after completing the useful life, I am expecting, let us assume that 10,000 as a scrap value from that. So that also I will be adding and I will be dividing it by 2. So the value which I get, that is known as average capital employed. I hope the formula for average capital employed is clear. Now shall I go with the limitations? Yeah. Any other queries? Yes. Now the limitations. Now very interesting limitations. I request the participants to please focus. Does not ensure that shareholder wealth is maximized. Very, very important point. Now, if you can recollect, when we started discussing financial management, we discussed that the primary objective of the finance manager is to maximize the wealth of the shareholder. Now, in this case, always it only focus on how much percentage of return we will be getting with a new project. But we cannot get any assurance, or it won't, this ROC won't assure uh, the wealth maximization of a shareholder. It means what I am trying to say, of course, a project might be getting a return on capital employed of 40%. Now, this 40%, does it ensures that my market share price will increase? Will the shareholder will be getting any assurance that the new project will be increasing the value of the shareholder, value of the share in the market? Absolutely no. It means that this ROC won't assure the wealth maximization. Then figures easily manipulated. Because why we say that figures easily manipulated? These are the extracts from the financial statements. In order to calculate the ROC, we will be taking the information from the financial statements only. So it is very easy for a manager to manipulate. And the most important point, ignores the actual and incremental cash flow associated with the project. Now, before explaining this, I want to give one more example for this manipulated. Let us assume that if you can recollect, ROC always focus only on the profits, not on the cash flow. I hope this point is clear for all. Now, if I consider the profit as a base, now don't you think I can use certain non-cash elements or to maximize my profits? Especially, I can include the profit on disposal of an asset so that I can maximize the profit. So it is a very easy way to manipulate the figures. And there are a good number of examples which a company can consider to what is this to manipulate the profits so that the return on capital employed will be increased. Now, let us assume that the company actual return was only 10,000, but during the year the company disposed an asset and the profit on disposal is 1 lakh. Now, if you add this 1 lakh, then the final profit before interest and tax is 1 lakh 10,000. Now, if I consider 1 lakh 10,000 as a base, now don't you think there is a possibility of overstating my return on capital employed? I hope you might have understood the point. So it is a very easy way for the managers to manipulate. Now, why the managers tends to manipulate this? I already mentioned that their emoluments are directly linked with the ROC. If they can project that the company ROC increase, then definitely their emoluments will also be increased. So greater possibility of manipulating the figures. And the last point, ignores the actual incremental cash flows associated with the project. It only focuses only on the profit element, but we are not considering the incremental cash flows from that particular project. Incremental cash flows means, what I'm trying to say here is, if a company go with the project, what is the additional benefit the project is giving? Let us assume that if a company want to replace an existing machine with a new machine. If a new machine is replaced, it will significantly reduce the power consumption. Let us assume that old machine is consuming around 10,000 units of power, but if it is replaced with a new machine, now it consumes only 2,000 units of power. Now there is a significant reduction in the power consumption. So this is an incremental cash flow which we should consider, but these kind of incremental cash flows are completely ignored because we do consider only the profits, not these cash flows. So these are the three limitations, and one more limitation, I think it is not included here, but I want to add it. It won't consider the time value of the money. So return on capital employed won't consider the time value. Here time value anyway, in the next concepts I will be explaining that, but just you need to remember that ROC won't focus on time value of the money. So these are the limitations. So any questions on this? If ROCI, it means profit levels are good, then won't the dividend paid to shareholders increase contributing to wealth creation? Yeah, here very good point, but let me clarify this. I completely agree with you. Now, generally, if the company ROC is good, yeah, it ignores the working capital requirement. If the company ROC is good, then we can assume that the company profits are good. But do remember, of course, the shareholders might be getting an additional dividend. I agree with you, but getting a higher dividend and increasing the market value of a share in the stock market, both are different. See, if a company is paying a higher dividend payout ratio, it doesn't mean that their market value of the share is increased. I hope you got my point. Say it might provide a temporary benefit because if they are getting a higher dividend uh, in a particular year, it is a temporary a benefit or a profit to them. But in long run, it doesn't mean that the share value will be increased. So this point, please you need to note. I hope I addressed your query. Yeah. So any other questions on the limitation? Now shall I go with the payback period? Yes. Now the next method is payback period. Now by seeing the title itself, you might have understood the concept. Payback means when we'll be recovering our initial investment on the project. Suppose let us assume that if you are investing 1 lakh in a project, and if the project is giving a cash flows of 50,000 per annum, then within 2 years we will be recovering our initial investment. So that is known as payback period. Now this particular investment appraisal techniques mainly focus on the recoupment of initial cash outflow on the project. So the formula is very simple. Payback period is equal to initial payment divided by annual cash flow. Now if the cash flows are uneven, this is very important point. Now it is not necessary that always we will be getting a uniform cash flow. So in practice it is very difficult. Suppose first year if you are getting 1 lakh cash, doesn't mean that second year also you will be getting 1 lakh. Always there is a possibility of receiving a different cash flow. So if cash flows are uneven, then the payback calculated using the cumulative cash flow over the life of the investment, then payback might not be an exact number of years. This is a very important point. Payback might not be an exact. It means that we can't say that payback period will be 3 years or 4 years or 5 years. Now organizations set target payback periods and will probably reject the projects which have payback longer than the target. It means that whenever they are making the investment decisions, first they will fix a target. It means they want to invest only on those projects which is having a payback period of 3 or less than 3. If a project is having a payback period of more than 3, they will completely reject that. So first they will fix a target. They are going to invest only on those projects which are having a payback period of 3 or less than 3. So on that particular basis, they will be considering. So let me explain a small illustration by using the Excel sheet. Shall I explain the average rate of return also? You want me to explain that? Yeah. I hope everyone can see my Excel sheet. Now let us assume that investment. So a project needs an investment of 1 lakh. Life of the project is 5 years. Then residual value 10,000. Now the profits, expected profit before tax for the first year, we'll assume it as 20,000. Second year it is 50,000, then 80,000, then 1 lakh, then 1,20,000. Now it means that if you start a project with an initial investment of 1 lakh, and if you are expecting that life of the project is 5 years, and after 5 years, if you are expecting that we'll be receiving 10,000 as residual value. So, and these are the profits. First year we are expecting a profit of 20, second year it is 50, and it goes to 1,20,000 in the 50. So by using this information, first we try to calculate the return on capital employed, and same query we consider to calculate the cash flows. Okay. So first return on capital employed. So I hope everyone might be aware about the formula. Average annual profit divided by average investment. Into 100. This is the formula. And I don't think you are confused with the average profit. This is very simple. So how we will calculate the average profit? Total profit. So the total profit during the year divided by number of years. So average profit is 74,000 and average capital employed or nothing but average investment that is initial investment plus residual value. What is our initial investment? 1 lakh plus residual value 10,000 divided by 2. So our average profit would be 55,000. So finally the return on capital employed is average profit divided by average investment. So 74,000 divided by 55,000. So the return on capital employed would be 1 point. So 1.34 into 100. So approximately we are getting a return on capital employed of 134%. So I hope it is clear. Any query? This is the procedure for calculating ROC. Yes. Now shall I go with the payback period? Yeah, sure. Let me explain it one more time. See, generally here investment is given, life of the project is given, residual value is, and the expected profits from the project is also given. So if you are assuming 5 years as life of the project, the first year the expected profit is 20, second year it is 50, and the last year approximately it is 1,20,000. So we need to calculate the return on capital. So the formula is average profit divided by average investment. I hope you can see the formula here. Average profit divided by average investments into 100. So how we will get the average profit? Total profit. So what is the total value of this profit? So total profits divided by number of years, that is 5 years. So we got 74,000 as average profit. Now we need to calculate the average investment. So the formula for average investment is initial investment, that is 1 lakh, plus residual value, that is 10,000, divided by 2. So we got an average investment of 74,000. Now the return on capital employed formula, just this information we are applying it in the formula. Average annual profit 74,000 divided by 55,000, that is average investment into 100. So if you invest on this project, you are expecting a return on capital employed of approximately 134%. So this is the procedure for calculating. Uh, in this case, average profit divided by initial investment. In this case, could you do an example of initial capital cost? I didn't get your query, Naina. I believe you are asking about annual
So
profit
the
divided by initial.
first method,
Sorry.
like the average annual profit by initial capital cost into 100. So
Yeah,
in
yeah.
that method,
Now, in that case, we won't be calculating the average profit here. Simply, what is our annual average profit? 74,000 divided by initial investment is 1 lakh. So instead of calculating the average investment, here directly we will be taking the total investment. So we will be getting a return on capital employed of 74%. So in this case, we won't calculate the average profit directly. Whatever our investment is there, that we do consider. So 74,000, that is average profit divided by initial capital, initial investment 1 lakh into 100. I hope it is clear now.
yes, sir.
When to use? Now this is a very good question. Initial capital cost or average investment. If nothing is given in the query, if nothing is given, then or in a simple way, if you find a residual value in the question, now always it is preferred to calculate the average investment, because definitely most of the cases definitely they will be giving a residual value. So if you find the residual value, then apply the average investment. If nothing is given means you can go with the formula, that is average profit divided by initial investment. But whenever you applied a specific method, try to clearly make a note of it. So you can, in your exam query, you can say that I assumed because the scrap value or the residual value is not given, then I calculated the return on capital employed by considering the average profit divided by average investment. It means a proper justification should be is mandatory. Not only in this case, if you are having two options and if you are going with one option, always try to clearly make a note of it. So I hope it is clear. Now the payback period. Now let us assume that instead of profits, let us assume that they would have given, they gave the cash. So by assuming this, now we calculate the payback period. Okay. Now here you can see the formula. Payback period is equal to initial payment divided by annual cash. So initial payment is nothing but the amount which you are paying initially. Means initial investment, that is 1 lakh. And annual cash flow, the expected annual cash flow. But this formula is applicable only when there is a uniform cash flow throughout the life of the project. But in this case, we don't have the uniform cash. First year the cash flow was 20, second year it increases to 50, and again it goes to 80, 1 lakh and 1 lakh 20. Now in this case, we need to accumulate, we need to go with accumulated cash flows, then we should calculate this. So I request everyone to please focus. Because the cash flows are not uniform, we need to calculate the accumulated cash flows. So accumulated cash flows, the first year it will be 20,000. 20 plus the next, then 1 lakh 50 plus 1 lakh, 2 lakh 50,000. I will explain. Since we are not getting the cash flows equally, because first year what is the expected cash, second year it is 50,000. If it would have been uniform means every year our cash flow is only 20, but in this case it is changing. So this is not, this is considered as not uniform. Okay. Now just try to understand here how I got the accumulated cash flows. Accumulated cash flows, or we can say the cumulative cash flows. So the first year it was 20, then we'll be immediately adding this, the whatever the succeeding year amount is there that we added. So 20 plus 50, 70,000. 70 plus 80, 1 lakh 50. 1 lakh 50 plus 1 lakh, 2 lakh 50, and 2 lakh 50 plus 1 lakh 20, 3 lakh 70. These are cumulative cash flows. So before I go with the next step, let me know if you have any query on the cumulative cash flow calculation. Is it clear? Cumulative cash flow? Yes. Do you want me to explain it once again? So after calculating the cumulative cash flow, what is our initial investment? How much we are investing in the project? What is our investment value? Yes. Our investment is, yes, 1 lakh. Now in the cumulative cash flows, in which year we are recovering the 1 lakh? In our cumulative cash flows, which year we are recovering? Yes, very good. in the third year, because in the third year our cumulative cash flow is 1 lakh 50 and our investment is 1 lakh. Very good. I appreciate the responses from the participants. Now listen carefully. Now in this case, we are getting our initial investment in the third year, but the third year cumulative cash flow is how much? 1 lakh. So what we need to consider is we need to take the preceding value. So the preceding value is 2. So 2 plus, listen carefully, the preceding value is 2. Why we consider 2 here? Because in the third year we are recovering our initial investment, but our initial investment is 1 lakh. But in the third year our cumulative cash flow is 1 lakh 50. So we do consider the preceding value, that is 2. So we will be taking 2 plus. And what is the cumulative cash flow in the second year? 70,000. Here you can see the cumulative cash flow in the second year is 70, right? But how much we need to get? 1 lakh. So 1 lakh minus 70,000 divided by difference between the second year and third year, that is 80,000. So we got 2.375. So it means that we are recovering our initial investment in 2 years and 0.375. Now this is again very interesting. How to calculate this is, now in a year how many months will be there? 12. So 12 into 0.375. So it is around 4.5. So our payback period will be 2 years, 4 months, 0.5. Again 0.5 into number of days in a month. So if you assume 30 days, so it will be 2 years, 4 months, 15 days. So this is our payback. Did you understood this? Anyway, I will be explaining it once again. Don't worry. Yeah. So first, let me explain this calculation part. Our initial investment of 1 lakh we are getting in third year. That is third year our cumulative cash flow is 1 lakh 50,000. So we need to take one preceding value. So preceding value is how much? 2. So 2 plus, and how much amount we should get? Actually 1 lakh. So 1 lakh minus, just focus on the formula. Just I highlighted the formula, so please focus. So 2 plus 1 lakh, that is our investment amount, minus our cumulative cash flow in the second year. How much? What is the cumulative cash flow in the second year? 70,000. Divided by difference between second year and third year. So what is the difference between these two? 80,000. So if you apply this, we got 2.375. Now this 0.375 into 12 months, because 2 means, yes, in the second year we are recovering the amount, but we got 0.375. So in a year we will be having 12 months. So 12 into 0.375, we got 4.5. So our payback period will be 2 years, 4 months, and again we got 0.5. Now if you assume 30 days in a month, so 0.5 into 30, we will be getting 15 days. So the total final payback period will be 2 years, 4 months, 15 days. Just look into this. So after this, I will be giving a small illustration. I want everyone to please calculate. Yeah, definitely. I will get. Which part you want me to explain? I hope everyone want me to explain this one, right? Okay. Okay, let me explain this. See, first I will be explaining this 2.35. So let me put in the steps way. Step 1. First, look for investment in cumulative cash flow. So that should be the first step. Second step, select preceding value. Suppose example, we need to in the step 1, whatever we said. So select preceding value of step 1. Okay. So that should be the step 2. So these two steps are very, very important. So first step, so the cumulative, our initial investment is 1 lakh. So that particular initial investment I will be getting in the third year. So as per step 2, I need to take preceding value, that is second year. So 2 plus, then second year, what is my cumulative cash flow? Only 70,000, right? But our initial investment is 1 lakh. So 1 lakh minus 70 divided by the difference between second and third. So how much difference is there? Third year it is 1 lakh 50 and the second year it is 70,000. So how much difference is there? 80,000. Okay, here you can see the difference is 80,000. So if you substitute it, we got 2.375. So it means that our payback period is 2.375. So 2 years plus 0.375. Now this, whatever the decimal 0.375 is there, that 0.375 into 12. Why I took 12 here? A year consists of 12 months. So that's why 0.375 into 12. So I got 4.75. Sorry, 4.5. So it means 2 years. I got 4.5. So that's why 4 months into this, whatever decimal value 0.5 is there. Now, if I assume 30 days in a month, so 0.5 into 30, I will be getting 15 days. So my payback period will be 2 years, 4 months, 15 days. Is that clear now? Yes. Will you try? Shall I give a small illustration? Will you try? Yeah. Mohammed, you asked me to explain 2.35. I hope you understood this part. Yeah. Now let us assume that our investment is 1,50,000. Cash flows. These are my expected cash flows. I request the participants to please Mute your speaker. So here you can see 5 years are there. Cash flows year 150, year 2 75, 1 lakh 10, and 140 and 170. Okay, sorry. Just give me 1 second. Yes. So year and cash flows you can find. Now, what is the first thing you need to do here? Is it even cash flows or uneven cash flows? Even or uneven? Yes, uneven cash flows are there. Now, what should be the first step for calculating payback period in case of uneven? Yes. So we should calculate the cumulative cash flow. Now, what is the first value? So you need to tell me, just I will be typing now. That's it. So what should be the first value I need to consider in the cumulative cash flow? 30,000. Very good. Second year. Yes, 80,000. Third year. 1 lakh 40. Fourth year. 2 lakh 80. Yes. Very good. And the last year, it will be 4 lakh 50,000. And I don't think this cumulative cash flow is, I hope everyone understood this. Now, my initial investment is 1 lakh 50,000. So in which year I will be getting this? In which year I will be getting? Very good. Fourth year, perfect. So fourth year means I need to take the preceding value. So what is the preceding figure I should consider? Third year, right. Now, so here, can you let me know? So what should I type here now? 3 plus
1,50,000 minus 60,000.
1,50,000 minus
60,000.
Now, can I know why 60,000?
Like we suppose to take the previous year's.
Yeah, previous years, should I take cash flow or cumulative cash flow?
Oh, sorry, cumulative 1,40,000. Yeah.
It's 1,40,000. Yes. Now divided by. Now what should be the value I need to consider? 1,40,000. So it means the difference between the third year and the fourth year. So third year is 1.4 and the fourth year it is 2.8. So the difference is 1.4, 1,40,000. So we got 3.07. So 3 years, but in order to know the exact months and days, then we got 0.71. So 12 months. So sorry. It is 0. 0.07. Don't confuse here because it is not 0.7. It is 0.071. Okay, so I got 0.852. So here you can see 12 into 0.071. Okay. I hope you are clear with this calculation. Now how much I got? I got 0.852. So how we need to assume now? 3 years. How many months? I'm very much interested to know the answer from the participants now. Previous case we got a decimal value 4.5 something we got. So we assumed 4 years. But in this case 12 into 0.71 we got only 0.85. So what should be the consideration here? Yes, Vikrant, 0 months. Yeah. Srivani, I think I got an interesting answer. 3 years, 26 days. Can I know how you got 26 days? Absolutely correct. Because we got 0.852. So in a month, if you assume 30 days into 0.85. So 25.56, or we can consider it as 26 days also. No issue in that case. So the total payback period PBP will be 3 years, 26 days. So this is the procedure for calculating. Any question? Any query on this?
Sir,
Yes.
so the amount that we divide is the cash flow of the fourth year, right?
Yeah, that's it. Because the difference between the third year and fourth year cumulative cash flow is nothing but cash flow of the fourth year. That's it.
Thank you, sir.
Okay. Any other queries on this? One question is compulsory. One MCQ we can definitely expect from payback period, and that too they won't give even, because even is very simple. They won't give that. So always they will be focusing on uneven cash flows. So that's why I request the participants to let me know if you have any question. Cash flows are even, then we did not calculate. Yeah, in that case, cumulative cash flow is not required. Because the reason is, if you invest 1 lakh and if you are receiving 50,000 every year, so what will be our payback? 2 years. Okay. Mohammed, you want me to explain the D's calculation? Okay. I think you're asking about this one, right? Now, when we applied this 0.71 into 12, we got 0.852. So it means that less than 1 month. So that's why we do consider 30 days. So 30 days into 0.852, you can just see the formula. 30 days into 0.852, we got 25. So this 25 is nothing but the number of days. So the payback period, expected payback period from this project would be 3 years, 26 days. Now here also, let me show this one. So how we got days here is, see here when we applied, we got 4.5. So it means 4 months. Again, this 0.5 into 30 days. So it will be 15 days. So the total payback period will be 2 years, 4 months, 15 days. Okay. So here you can see the payback period may not be the exact number of years. Now the strength and the limitations of this, simple to calculate and understand. It favors quick return, so helps company grow, minimize the risk, maximize the liquidity. Now let me explain the minimize the risk and maximize the liquidity. Suppose always the company will focus on those projects which is having less payback period. Nothing but if two projects are there and the project one payback period is 2 years and the project two payback period is 4 years. So whatever the initial amount was invested, so from project one we can recover it in only in 2 months. Sorry, in 2 years. It means the investment risk will be very less and maximize the liquidity. Now it means that liquidity is nothing but availability of funds to meet their expenses. Now if the project is giving your total investment in 2 years, so definitely the company will be in a better liquid position. It means they can meet their requirements without depending upon the external sources. So if a project is having less payback period, it will definitely maximize the liquidity and the investment risk will be significantly reduced, because if you can recover the total investment in 2 years or whatever the payback period is there, if it is less compared with the other projects, so it will definitely minimize the investment risk. And it also helps the company to grow. Now let me explain how it will aid the company to grow. Let us assume that if you are recovering your initial investment in a less period of time, it will open the diversification option. It means they can diversify their investments and it quickly, and it allows the company to go for an expansion also. So this will maximizes the chance for a company to grow. And the first point, it is very easy to calculate. I don't think I need to give an explanation, but the limitations are very important. Does not ensure that the stakeholder wealth is maximized. So it is also silent about the wealth of the maximization. Nothing but stakeholder wealth maximization. Then ignores the timing of cash. Now it means that if you can recollect when I was explaining the limitations of ROC, I spoke about time value of money. So same time value of money is not considered by the cash. Now let me explain what is this time value. Let us assume that in case of these projects, here you can see, if you focus on these cash flows, let us assume that on 2020, in 2020, I invested 1,50,000 on a project. After 1 year, that is in 2021, I am expecting 30,000 cash. And in 2022, I am expecting 50,000 cash. But here I am not considering the time value, because today money and tomorrow money is definitely different. We cannot give equal status for present money and the future money. Or technically speaking, we cannot give equal status to the present value of the money and the future value of the money. Now, let me go in detail, because the next concept is not only time value. Now, why there is a difference between present value and the future value? So I thought of, I will be giving an example with this. Suppose today I am having 1 lakh rupees. Now I want to go with a laptop. I want to purchase a laptop. Now I want to go for an Apple laptop or a high configurated laptop. So today its market price is 1 lakh and I do have 1 lakh. So it means that I am having the purchasing power to purchase that particular laptop. But if my friend requested me to lend the money, that means to give the money for a period of 3 months. It means he want me to give that particular 1 lakh for 3 months. After 3 months, he will be paid. Now let us assume that after 3 months, if he repay me 1 lakh, now here the question is, do I have the same purchasing power to purchase the laptop at the end of the 3rd month? Because of course today its price is 1 lakh, but I'm not very much sure that the price will be same at the end of the 3rd month. Of course, it might go down or it might go, it might increase also. So always I need to consider the negative impact. So if I forgo this 1 lakh, if I forgo my current purchasing power for a period of 3 months, now definitely I will be expecting my nothing but whoever received the benefit to compensate me for forgoing the purchasing power. Now in this case also, if the purchase, if the value of laptop after 3 months is increases to 1,10,000. So it means that if I receive only 1 lakh from my parent, then definitely I won't be having the required power to purchase it. So the present value is 1 lakh and the future value is 1,10,000. It means what I am trying to say, because of the changes in the price rates, or technically speaking, because of the effect of inflation, definitely the value of the money changes. So today, suppose a simple question I can ask. Suppose if I give two options, whether you need 1 lakh today or 1 lakh after 1 year, now definitely you will be going with today's 1 lakh only. Now, can I know the reason why you will be preferring to go with today one? If I give two options, you want 1 lakh today or 1 lakh after 1 year. So which one you prefer? Most of you generally go with the today's 1 lakh only. But the reason why? Why you want 1 lakh now? Why you don't want to wait up to 1 year? So its value will be more, value will decrease in future, inflation, very good, because of these factors, the inflation and other factors, the value will significantly change. But in this case, I am expecting 30,000 for 1 year after 1 year, 50,000 after 2 years, 60,000 after 3 years. That is the future value. But what is the value of 60,000 now? Suppose here, if you see, I am expecting 50,000 in 2022, but I am making the decision in 2020 itself. So what is the present value of 50,000 in 2020? That is known as considering the time, but I ignored you. So that's why the time value concept is ignored. So this is the ignoring the timing of the cash. And the next one is ignoring the returns after the payback period. Now here in this calculation, I am very much focused only up to the payback period, but I am not considering the returns. That is, post payback returns are ignored in case of payback. Suppose in this case, my payback period is 3 years, 26 days. So I am focusing only on the payback, but I am not considering the effect of post payback returns. So this is also a limitation, and it is subjective. So no definite investment decision. So it means it is subjective means just I am focusing only on how, when I will be receiving my investment amount. That's it. But here I am not focusing on the expected amount of returns. Of course, I am investing in a project, and the project is giving back the investment amount in 2 years. But how much return you are getting? So payback period is silent about the expected return on the investments. So these are the limitations. And if you have any query, let me know. Any queries on limitation? Yes. Am I audible? Yes. So shall I assume that you understood the limitations part of payback period and the calculation? Yes. Next. I will see a small question. Limitations last point. It is subject to see the payback period. It only focus on when we will be receiving our initial investment. So there is no investment. It means that we do consider when our investment will be getting back, but it is silent about the expected return from the project. It means let us assume that how much return we are expecting from that particular investment, whether we are receiving, we are expecting 20% or 30% or 15% return. Okay, it only focus that what is the time period within which our investment will be recovered. So it is silent about the expected return on the investment. So that's why we consider it as subjective. Okay. Yes. Now we'll have a query. Dot clarification. I think some students is having some queries. So can you let me know which doubt you have? Yes. I think Leela, you asked me a query, right? So can you please let me know the doubt, which question you have? Page number 18 in the study book. Is it 2021 or 1920?
So this book only page number 18, so the managerial reward schemes question.
I'm in page number 18.
So
Yeah, this one.
yes.
Okay. Yeah. First, let me read it. Gets INC, a listed company, has developed a highly successful new product and is thus growing rapidly. However, with this growth, the firm is experiencing cash flow issues. Now, managers are currently awarded bonuses if there is a growth in the reported earning per share. So here managers are awarded a growth in the emoluments if there is a growth in the earning per share. But here the issue is developed a highly successful new product and is growing rapidly. However, with this growth, the firm is experienced because I think they might be facing certain liquidity issues. So the answer, okay. So what query do you have on this?
So like suppose if they ask this questions, in the answer they've given it as advantages and disadvantages. So should you write it like that, or can we just write it how we want?
No, here comment means yes, obviously whenever you are asked to give the comment, so always it is preferred to give advantages and disadvantages. So you need to give your opinion, comment on that, right? Now, how they gave here? Let me show that. It is additional question, right?
Yes, sir. Page number 32, sir.
Yeah, same advantages they give, no? Advantages and disadvantages. Suppose mainly advantages. Anyway, the common expected point they will be focusing on goal congruence, because here the managers are rewarded on the basis of desired EPS. So if the company EPS increases, definitely it will increase the wealth of the shareholders. So here we can see. So goal congruence, managers will work to achieve the growth in the EPS, which will make shareholders feel that their wealth is increasing. And the figure is but not impossible to manipulate from one period to another, as it is, it will be audited. Yeah, you will be getting the study material, don't worry. Yeah. Now, second point I want to mainly highlight, to manipulate from one period to another, because if you are linking the emolument of directors with the growth in the EPS, now first we need to see, is there any possibility by the managers to manipulate it? Because chances are there, right? But in this case, we cannot say that it is impossible, but it is difficult because it is audited. And if you can recollect, there is a specific accounting standard called IAS 33. So as per IAS 33, a company, a listed company, need to definitely disclose their earning per share, and an auditor need to follow all the required procedures to know whether the EPS is correctly calculated, and he need to specially focus on the scrutinization of EPS calculation. That is mandatory as per IAS 33. So we cannot say that it is implausible, but very difficult for the managers to manipulate, because if you are linking something to their emoluments, means they try their level best to do that. So these two are the advantages, and let me focus on the disadvantages. There is a little incentive for management to control working capital and cash flow. So it means that the major issue which was addressed in the query is they are facing the liquidity issues. Now, liquidity issues means they don't have the sufficient cash to meet their regular operational requirements, or technically speaking, they don't have sufficient working capital to meet their requirements. But the incentive is silent about the working capital. So here growth may be at the expense of liquidity and ultimately compromise the firm's future survival. So because here it focus only on the EPS, not on resolving the liquidity issues. And managers may gain bonus simply because of the product concern rather than over effort. So a target growth in EPS would be better, and long-term shareholders value at EPS are not well correlated. Of course, definitely if a company earning per share increases, means there is a possibility that the market price might be increased, but this is only for short term. So we cannot expect that if a company increases the EPS, it will result in increasing the wealth maximization. And there is only one measure that focus on final effects rather than operational causes. So it means final effect in the sense earning per share. So it is silent about the actual issue, that is liquidity issues. So one point I want to clearly mention here, whenever you are asked to give your comment, so definitely you need to give the advantages and disadvantages. I hope it is clear. Did I address the query now? Any other questions? And I hope all the participants might have explored LMS. Now in the learning management system, in the resources, you will be finding all this, so you can download the required material. I hope everyone might have downloaded the study, what is this, examination kit and pocket notes. Yes. Let me know any other questions on this. Which area you found difficult? This is very good question. For registering the December session, as early as possible, whenever the slots are open, so try to register as early as possible. I think some confusion will also be there, I think, as per my knowledge. Or from a finance manager perspective, if you are asking the question, now when try to buy some foreign currency, whenever you found the what is this Indian rupee value is appreciated compared with that ball. I hope you got my question. Suppose maybe in the next 10 days or 15 days, if you observe that the value has decreased, then go for that and you can use it to pay the fee. And one thing is, I want everyone to clear this December paper. What is this in December? This FM paper should be done. Yes, but I didn't get answer for my question. I want to know how many of you gone through the assignment, because on Friday I asked everyone to refer the MCQ part relating to finance manager functions and the environment. And I asked you to ask the queries also. So just I want to know how many of you want. Okay. I got only one query. Others, please. So should I assume that you are clear with all those MCQs? Some difficult words. Can you highlight any specific term which you found difficult so that I can explain it?
Yes, sir, just 1 second.
Yeah. You can take it.
So like in section A, question number 21.
1 second. So I hope this is the one, right?
Yes, that one.
Okay. So first, let me read it and try to explain it. Which two of the following statements are correct? Securitization is the conversion of illiquid assets into marketable securities. The reverse yield gap refers to equity yield being higher than the debt yield, and this intermediation arises where borrowers deal directly with lending individuals, and demand pull inflation will occur when there are increases in the production cost independent to the state of demand. Now here the requirement is state which of the following statements are correct. Now let me give an explanation to this. So I hope everyone can see this particular 21st question. Now first one, let me highlight the first one. That is, debt securitization is a conversion of a illiquid asset into marketable securities. Now let me explain this. Now there is a concept called debt securitization. Now debt securitization means, see, illiquid asset, liquid asset. Liquid assets means the assets which can be converted into cash within a period of 1 year. Assets which can be converted into cash within a period of 1 year is known as liquid assets. If you are unable to convert it into 1 year, then that is known as illiquid assets. Now let us assume that a bank, I want everyone to please focus. Actually, this is an AFM related concept, but only just for your understanding they included it. So very interesting concept, please focus on this. Now, a bank issued a housing loan to a customer. And let us assume that the term of the loan is 10 years. The term of the loan is 10 years. Now, from a bank perspective, should we consider this loan as a liquid asset or illiquid asset? If you didn't understand my question, let me know, I will repeat it. Should I repeat the example once again? Yeah. Suppose a bank, ICICI Bank, sanctioned a loan to a customer and the loan term is 10 years. Loan term is 10 years. My question is, should we consider this loan? It means I am asking from the bank point of view, bank perspective. Now, if a bank sanctioned a loan to a customer, means definitely an asset. I don't think I need to give further explanation. But in this, do we need to consider this as a liquid asset or illiquid asset? Liquid asset means if you can recover your total amount from your asset in 1 year, that is known as liquid. If you are unable to recover it in 1 year, that is illiquid. Now, in the given example, do we need to assume this as liquid or illiquid? I got an answer from James. So James thinks that illiquid. Very good, James. Yes, perfect. I appreciate the participants for giving the answers. So definitely it should be considered as a illiquid because the term of the loan is 10 years. Now, what is the securitization? These banks, they will convert these illiquid assets into liquid assets. It means what they will be doing is, say, I am a bank, I am an ICICI bank. Now, I will be receiving a regular payments through my housing loan from my customer, but I am not receiving the total amount in within 12 months. But I need an urgent money. I need the funds for my expansion. I can't wait for 10 years. Now, what the bank will be doing is they will go for debt securitization. It means that here the banker should receive an amount from a customer for a period of 10 years. That particular amount will be sold. It means the bank will be selling this particular asset to another company. It means they will keep this as a security. They will be keeping it as a security and on that they will be receiving the amount. So in this case, no need to wait for 10 years. Suppose bank should get 8 lakhs from the customer in a period of 10 years. So this 8 lakhs will be taken or will be considered as a security, and by showing it as a security, they will be raising the funds. That is known as debt securitization. Now, technically speaking, we are converting an illiquid asset into liquid asset. I hope you understood the concept. Is that clear?
Sir,
Yes.
Sir, we say that in case of current assets that its payment period also matters, right? So can't we say that till 10 years it is a cyclic?
Yeah, yes, but in this case, we are not recovering the total amount. It means, suppose if a bank gave 8 lakhs as loan, so do they recovering total 8 lakhs in 12 less than 12 months? No, no. Of course, they might be getting certain amount regular contribution, but they're not recovering the total amount. See here, don't think from the borrower point of view. Just focus from the lender point of view. Because most of the banks, what they'll be doing is, if they face significant uh, what is this liquid issues, or if they want immediate funds for their expansion, they will go with. And this is a innovative strategy. Actually, it was what is this came into limelight maybe around 5 years or 6 years back. So it means they will convert their non-liquid or illiquid into liquid. And the question, your question, what you are trying to ask is the current assets. See, is it from your company perspective or from the borrower point of view? The current assets which you are highlighting.
So the company perspective.
So company perspective, there is no concept of debt securitization from the company. See, company perspective, let us assume the current assets are nothing but the assets which can be converted into cash. That is known as current asset. So, if you see the definition, the current assets can be considered as the liquid assets. And the plant and machinery or the investment property which are used for in long run, that can be considered as an illiquid asset for a company point of view, right?
Yes.
So I hope the first point is clear. In normal financial management function, no, this is not from the financial management function chapter, but your examiner will be shooting these kind of queries also, because they don't want to give the mark that much easily. So because this is the reason why I ask you to refer the technical articles, because you won't find these kind of things in your text study text. Now you will get the knowledge only from the technical article. So that's why you should refer the technical article. Okay. Now the second point, that is the reverse yield gap, refers to equity yields being higher than debt yield. Now reverse yield gap, what does it mean? Any idea about this? Now let me explain this. Now generally reverse yield gap, normally if you invest in debt or if you invest in equity, from where we can expect a high return, equity or debt? Uh, in case first case relating to here, not exactly factoring here, because factoring mainly focus on receivables only, na? Because factoring deals with your current assets. So we cannot apply the securitization concept to the factoring, because factoring means if you are selling your receivables to the outside party, that is known as factoring. Suppose I am having a debt, nothing but receivables of 1 lakh, and I'm unable to recover. So that's why I outsourced my sales ledger to the third party. So my sales ledger is nothing but current asset. So current asset is not a illiquid asset; it is a liquid asset. So we cannot apply the factoring concept to what is this, to the securitization. I hope it is clear. Yeah. Now the second question, just I asked about the return on equity and debt. So I hope most of you might be aware, we will be getting higher return on equity compared with the debt. So we will be getting a higher return on equity compared with the debt. But here reverse yield means getting higher return on the debt rather than the equity. That is known as reverse yield. But the statement gives a different picture here. Reverse yield gap refers to the call equity yields being higher than the debt. That is known as normal yield, not the reverse yield. So that's why statement 2 is Incorrect. Is that clear? Any query? Yeah. Now the next one, disintermediation arises when the borrower deals directly with the lending individuals. Yes. Now disintermediation, the word only speaks. There is no intermediation, right? So in this case, there is no different intervention of different channels. So directly borrower will be dealing with the individuals. So the statement 3 is correct. Then demand pull inflation will occur when there are increase in the production cost independent to the state of demand. Very, very good question. Demand pull inflation will occur when there are increases in the production cost independent to the state of demand. Now, what does it mean? What do you understood in anyone? Very easy. Just try to understand. What do you mean by demand pull inflation? I tried. Now, definitely, I will be extracting answer from you. What do you understood by this word? Demand pull inflation. Definitely, you can give the answer.
So when demand is high, people will try to make the cost of the product high so that they have the demand anyway, so they'll get the
Excellent.
price of that anyway.
Excellent. Very good. You mean to say that the producers will try to increase the price if the demand is more, in simple, right?
Yes, sir.
Very good. Now just see the statement now. Demand pull inflation will occur when there are increase in the production cost independent to the statement of demand. Now is it a right correct statement now?
No, sir.
Because if you are increasing the price, if there is increase in the demand, but demand pull inflation speaks about that only. But it speaks about the increase in the price with an increase in the production cost. Normally, if the production cost increases and if the producer is increasing the price, that is known as cost push inflation, not the demand pull inflation. Okay. If you are increasing the price of the product or because the production cost increases, that is known as cost push, not the demand pull inflation. I hope it is clear.
Yes, sir. And even in the 19th question, there's dividend payout ratio. What is dividend payout ratio, sir?
Dividend payout ratio means, let us assume that a company, the total returns of the company during the year is 1 lakh. Okay. And out of 1 lakh, company paid 40,000 as dividend to the shareholders. Out of 1 lakh, company paid 40,000 as dividend to the shareholders. Now, can you let me know how much percentage they paid now? The total return is 1 lakh. Out of 1 lakh, they paid 40,000 as dividend to the shareholders. So, how much percentage of return is paid as dividend?
Okay,
40%.
40%. Okay,
That is
understand.
nothing but dividend payout. Okay, the amount of dividend paid is known as dividend payout ratio. Okay.
And one more doubt, sir.
Yeah.
In section B,
Hmm.
like first question, A and B all have different words, sir. I don't know any word and all of that.
Okay. Now
Like A
section
and B.
no. Now section B, don't worry about this because most of the section B questions are blended questions. Blended means it includes the other chapters also. So especially the section B questions, it includes other chapters. So don't worry about that because once you're done with all the chapters, it will be easy for you to go with the section B questions. Now, can you let me know the page number of section?
So page number 52.
Page number 50. This question, right? This one, right?
A and B in the
Which two dividend concept theory? This is related to the dividend series. So that's why I said, so these are the blended questions. So here it includes the concept of the other chapters also. So don't worry about it. Now this is dividend theory. There are some relevance and irrelevance theory, Modigliani and Miller. Don't worry. When we cover that chapter, you can understand.
Okay, sir.
Okay. And here one more question I got. December. Now you should pay by yourself only, Joel. We won't be giving any information regarding that. But I think your coordinator, whoever your college coordinator is there, so I think they will be letting you know the dates of this December exams. So definitely you will be receiving a communication, I think from ISDC, and you will be receiving communication from your coordinator also. Okay. Any other queries? Maximizing, now here you should not confuse Srivani here. Maximizing market share, because most of the students they think that maximizing market share means increasing the share price in the market. No, no, no. Maximizing the market share means capturing. It means increasing your reach among the customers. So it is considered as a non-financial object, not a financial. Suppose already you are selling your products in India. Now you want to sell it in UK also. That is known as maximizing the market. It is a non-financial. I think you might have confused this market share means increasing the share price in the stock market, right? If it is increasing in the share price in the market means it is a financial object. But maximizing the market share means spreading your product, nothing but selling your product without any geographical barriers. Any other questions? Tomorrow we'll have a discussion on the discounted cash flow technique. This is very important chapter. So I request the participants to once go through this chapter, just go through the study text part of this chapter 3. So next two classes will be focusing on this chapter. Okay. So that's it for today's session. So if you have any queries, you can let me know. 10th question of section A in exam kit. Okay, let me open. I think as per my timetable, no class. I hope you are asking about this one only, right? Yeah. So what is the main purpose of corporate governance? So to separate ownership and management control of organizations, to maximize shareholder value, to facilitate effective management of organizations, and to make organizations more visibly accountable to a wider range of stakeholders and to ensure that regulatory framework are adhered to. Now, a simple a line I said, if you can recollect, the main objective of corporate governance to increase the credibility among the stakeholders. Just do remember, the main objective of the corporate governance is to increase the credibility among the stakeholders. Now, what is this credibility? It means whatever the business activities are there, if these business activities are performed with a specific code of conduct, then that we consider it as credible. So when I can say that a company will be having credibility, if all the required laws, regulations, ethics are followed, then I do consider it as credible. Right? So with that particular explanation, what do you think? Which statement speaks about the main purpose of the corporate governance? Vardhya, can we write the answers in our own? Definitely, you should write your answers in your own words. Don't ever try to present the replica of your study text or the exam key. Don't ever try to do that. Always try to put your own words. Now, for a corporate governance, I want to give a good example. Let us assume that two companies are there, company X and company Y. Now, uh, they are manufacturing certain products. Now, if any complaints are there by the customers, now it means what I'm trying to say. Suppose if the customers are not satisfied with the product, or if they do have any complaint, they can directly write their complaint to the HR department, and the HR department will send that particular complaint to the production department, and the production department director will give the reply for that. This is in case of X Limited. But in case of Y Limited is having a separate complaint redressal committee or customer redressal committee. Now, this customer redressal committee is having around 10 members. 5 members are their executive directors, and other 5 members are non-executive people who are not involved in the regular affairs of the company. Now, in these two cases, in which company from it means if you speak from the customer perspective, so from which company the customer will get a better justice, company X or company Y? Obviously company Y, because they do have a separate committee. They do have a separate committee and they do have an expertise in that particular company. So it means that the corporate governance system of company Y is good compared to the company X. So now in this case, in case of company Y, don't you think the company Y is having more credibility compared with the company X? So with this explanation, I hope now you can easily recognize the right option. So what is the main purpose of the corporate governance now? What is the right option? Yes, very good. It is option. Any other queries? Now here we do have two concepts: ex dividend, cum dividend. So if you are considering the value of equity by including the dividend, that is known as cum dividend. And if you are excluding this, sorry, let me a small correction. If you are including the dividend when calculating the value of equity, then we consider it as cum dividend. And if you are excluding the dividend for calculating the value of equity, that is known as ex dividend. Anyway, we do have separate concepts of this. But I hope you might have understood the difference. No. Shall I once look into the 19th question? Indicate by ticking the relevant boxes below where the following statements are true or false. So value for money is usually taken to mean economy, efficiency, and engagement. Is it true or false? I hope you can easily pick it. True, sure. Economy, efficiency, and what is the other one? Is it engagement? It is economy, efficiency, and effectiveness. Okay. So please make a note of it. It is not engagement, it is right. Next, come dividend. Now, come dividend means the buyer of the share is entitled to receive the dividend. So, as I mentioned, if it includes the dividend. So, is it true or false? So, come means including the dividend. So, whoever buys the share, he will be entitled to receive the dividend which is going to receive in the short time. So, it is a true statement. I hope it is clear. Then the dividend payout ratio compares the dividend per share with the market price per share. Now, do remember, now dividend payout share ratio always compares the dividend per share with the earning per share, not the market price per share. The agency problem means that the shareholder wealth is not being maximized. So I hope you might be knowing this. This is a true statement. So any other question? I appreciate the participants for asking the queries. Very good, and I expect same to be continued for the remaining sessions also. Okay, okay then. So that's it for today. Have a good day. So tomorrow we'll discuss the discounted techniques. Okay. Yeah. So I'm ending the session.